Right. Hello, everyone. Is everyone ready for our first lecture? I'm doing this recording from my house, my living room. Okay, so this is first time. So anyway, just a quick introduction of myself. My name is Mr. Liao. Right, I'm your lecturer for this financial and derivative. Hopefully, you guys are in the right modules. Right. Hopefully, we see. Let's have I got everything? Let me just switch over to my lecture notes. Right, right. So, IT 2635. Okay, so this is a third year module for your DFF, right? DFI, sorry. So we're going to take a look at this. So what is this? Okay, so the aim of this module is basically to introduce some principle of investment, right? To teach you something about investments, right? Which is very important, right? In life, you don't just work, okay, for money. You also want to make your money be wiser and be able to get your money to work for you, right? So that is a very important skill set, and I hope you guys will get to learn how to invest intelligently, right? So we'll basically be touching on the financial derivative, right, and some of the instruments that you will be learning along the way, and basically we'll try to teach you on some tactical approach in terms of managing the risk, right? So, so you can see the word. Maybe some of you are not very familiar with the word financial derivative, right? So it's basically something that you derive from, right? So it's a financial derivative that derive, okay, its value from some basic other instruments, such as what? Such as bonds, stocks, okay, which we'll be looking at. Okay, so in fact, these are the important financial derivatives of the last century. Okay, so somebody has invented these financial instruments. Okay, that is now becoming a very important tools for us to manage some of our financial risks, right? So while they are being taught as a tools for speculations, for gambler, for investors to come in to use it as a form of making money, right? It's also being emerged as an important risk management tools in the corporate world, right? So this is something that we'll be looking at. So the module objective is we hope to give you more knowledge, basically try to train you in the area of financial literacy, especially in putting your money to good use. Okay, so that's why we will be looking at evaluating some stocks and bonds, right? And looking at the various different type of financial derivatives, right? The four very important one that we'll be looking at is the future, the forward, the swap, and the options, right? So all these we have at least two chapters on each of this contract, right? As much as so knowing the derivatives, we'll be touching on some practical applications of these instruments in the areas of risk management. With that, okay, we hope that you will realize the incredible potential of this financial derivative and that you will know how to do some of this hedging analysis as well as investment strategy, right? So that will be very important. Right, so this module is actually a 60 hours, 4 credit points, and you can see something good. So because of the COVID crisis that we are having, so we are turning this whole module into a home-based learning, a lot of e-learning, but we'll explain a little bit more in maybe another short lecture. So, but most important is we have did some transformation in terms of the grading part, right? We have reduced tremendously on some of your written tests, right? So you guys are the lucky lots. Huh? We don't have a lot. We have in place, we have put a higher weightage on individual assignment. It used to be a group assignment, but now we try to discourage too much of the you physical contact with each other. So I'm actually putting more focus on the individual assignment, and there will be class participation, which we will participate. Hopefully, you guys will be more proactive, interactive during our e-chat, online chat, and there will be at least 3 quizzes and of course the final exam. Okay, hopefully we can have the final exam. We'll see how whether it's possible to conduct. Right, at this point there is a 30% examinations. Well, here you can see the kind of tentative plan, right? The module delivery plan that we have, and you can see that the quiz are here, 1, 2, 3. So they are on the different weeks, right? Your written assignment will be after your term break. Okay, so give you some time to prepare, but maybe somewhere in week 2 or week 3, I might want to talk a little bit on the assignment so that you can start thinking of how to start off with, right? And the class participation. Textbooks, these are the recommended textbook, but I don't think you need to buy them, right? Nowadays, a lot of information is actually online, and they are even more current and more up to date. Right, so chapter 1. So in our first chapter, we'll basically bring you through some overview of the financial market. Okay. Going through some of the financial assets, the processes that's going to go in place, and especially will dwell a little bit more on the stock exchange, right? And also the difference between that versus over-the-counter market. So, stock exchange, this is like the open outcry, right, that people have on the floor, right? So you can see they're all packed with people crying for prices, buying price and selling price, trying to match make buyer and seller, right? So it's basically a trading floor, right? So this is like simulating the a very big market exchange place. So the process of trading is basically there must be a buyer and seller, and they must be able to match or come together, right? So they can either come together in some of these exchange like marketplaces, like stock exchange, derivative exchange, or through some broker, right? Middleman. And then trade has to be clear, right? Everybody have to be agreed on the price, right? So before the whole stock transaction can go through. Right, so market trading has to be settled. The buyer has to pay the seller, right? The seller has to deliver the group, and they have to satisfy certain obligations, transaction obligation, before the whole transaction can be completed. And then there's an exchange of maybe certificate of ownerships, etc. Right. So you might not have this page, but because this is a little bit more personal, right? This is actually my trading page with CIMB Bank, right? So I have a stock exchange. I have a trading account to buy shares, buy stocks, right? So typically, next time when you go out to work, you might try your luck and then try your investment strategy on this online trading, right? Stock exchange with all the live data. You can see these are some of my watch lists, right? You can see SIA share. These are quite current. This is 13th of April, right? So quite current stock price. So you can see the SIA shares. What's the current last traded price? This is the last traded price. Just going to give you an overview of the stock exchange, how things are conducted, right? So if you go into online, you can see all the real-time live trading prices, and it will fluctuate by the seconds, by the minutes, and you will fluctuate, right? So this is like the last transacted price for SIA, which means it's $6, right? About $6. DBS, well, more expensive, This one about local bank and the blue chip. Usually blue chips are more expensive. This is $19, right? So here you also got the changes. You can see that red are usually reflecting that is a downward trend. The stock is losing money. So there's a percentage of change. It's about minus 1.5% change, right, since the last price. And how much volume of people buying, trying to sell, and how many people are buying. So you can see that the currently there are more selling, okay, more people selling, and then versus more less people buying the SIA share, right? So in view of the COVID, you can see that airline industries are actually not moving, right? The planes are all stationed at the Changi airport, right, at the airport. So no business coming in. So you can see there's a pressure on the price, right, to drop, right? So that's why you can see there are more people selling, right? So, but anyway, the market price has been going up and down recently, right? So you can even see Genting, OCBC, Singtel, Singpost. These are just some of my watch list, means my favorite list, or because there's so many stocks, right, in stock exchange. So you can actually, it's just like shopping cart, right? You can put it on a shopping cart or your wish list. Then you can just focus on these few stocks counter, right? So here is the percentage here. You can even see most important is actually the bid and the ask price, right? So for every stock counters, there's actually a bid and the ask price, right? So which means it's actually their 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 buying price and also their selling price, right? So that is their selling price, which means what? This is the ask price. So if you want to buy SIA shares, right? For example, you want to buy uh SIA share. No, let's take a look at this. So now I'm actually trying to insert an order, right? To buy what? Uh okay, buy DBS share. Okay, I'm trying to buy a DBS share. So what was the DBS share price? Last transacted price was 19.27. That was the last price that was being successfully transacted, right? So now I want to buy, right? So when I want to buy SIA share, I have to look at the ask price. So please pay attention when you want to buy stock, right? You are basically looking at the asking price, and usually it's higher than the bid price. You notice, right? Because you can't be buying at this price, and then if you buy this price which is lower, and then you will just sell it back to the stock exchange, you win, right? Cannot be, right? So you have to look at their asking price. This is their asking price, which means that is the price that you're going to buy from the stock exchange. So you're going to buy. So you can see that I have just entered an order to buy, okay, and that price is actually getting from the ask price, which is the higher one. Buy, you look at the ask price. How many am I buying? 1,000 shares. Okay, so usually 1,000 shares equates to one lot. So we usually say one lot, DBS. So 1,000. It's just like 1,000, 1K, right? So 1,000 means what? 1,000. So what is the total value, right? If I want to buy 1,000 units of SIA share at this, so what is the price that I need to pay? 19,000, okay? It's not like $19. So this is $19. So I have to fork out, right? $19,000, almost $20,000 just to buy 1,000 shares, okay? One lot of DBS, right? And I'm actually paying through cash. So you can specify you want to pay through cash. So that's buying. Remember, buy. When you want to buy, you look at the asking price. So what about another counter? Let's take a look at this counter, right? So I can also sell, right? Let's say I have a SIA share, right? So I want to sell. So what's the price for SIA share? Last transacted was $6.04, right? So you can see that was this, right? So if I want to sell, remember just now buy, I look at the ask price. When I want to sell, I don't sell at a higher price. I'm selling at this bid price, right? Which is the buying price for stock exchange. From their perspective, from the angle of the stock exchange, they want to buy at this. So you can only sell at this. So you see when I enter the sell order, right? You pick up the bid price, and I'm selling, let's say 10,000, right? Instead of 1,000, this is 1,000 only. Now I'm selling 10,000, so 10,000 times 6, which is what, 60,000 worth of SIA share. So if I have a 10 lots, right? So this is like 10 lots, 10,000 share is like 10k, so 10 lots. So 10 lots of SIA share, it will worth this 60k, right? If I manage to sell. And I can also specify, okay, my payment methods, or I'm going to receive it into my CPF. So you can actually use your CPF money to some of the special account to buy stock and shares, right? So without using your own actual cash or disposable income. So, but when you use CPF means whatever gain, whatever money will actually go back to CPF again. So that's something that to take for you to take note. But I'm just telling you, you can specify the different mode of payment, either use cash or CPF, right? So this is just a quick overview, quick view of how simple stock can be traded over the stock exchange, SGX, right? Singapore Stock Exchange. So here we have another example, right? So to further illustrate on the bid and ask price. So this is the bid or ask price, or sometimes we call the offer price, right? So $50 bid price is this, and now we added in commissions, right? So something for you to take note that these are like the broker commissions, right? So the middleman, they need to whenever you buy or sell, right? Commission, whether you gain or lose money, commission will be incurred, right? So here, let's check this out. Now I want to buy 100 shares, right? So depend on some stock exchange counter. Some shares allow you to buy 1,000, some allow you to buy 100 share or 50 shares. So it's up to you, right? So but you got to see whether it's tradable, right? Right, so here we have 100 shares, right? So some counter, they don't entertain odd shares, right? You don't get funny shares like 89 shares, so some counter they don't, but some will just be easier to calculate if you just get the whole block of shares, right? So 100 shares of XYZ. So if I were to buy, right? So if I were to buy, remember, I was to look at the asking price or the offer price, right? So 100 times 50, okay, 100 shares. Since I'm getting 100 shares, this is the price of one share. 100 shares times 50 will give you $5,000, right? So the total value that I have to come up with plus commission is 5,015, right? If I were to sell it immediately, I will have to sell at this price, okay? So if I were to sell at this price, and when I sell with 100 share, so it's this 4,975, right? But you have to minus off the $15, right? The commissions. So that will give you a little bit lesser. So what happened? Do you make a profit or gain out of this? So you can see that the buy price is this, okay, higher than your selling price. Obviously, you're going to lose money, right? Your buying price, buy at 50, sell at 49. Of course, you're going to lose money. So how much you're going to lose? That is the differences, and that will be the money that you're going to lose, right? So it's $55, right? So that's just a simple calculation on the stock exchange, right? So just remember, whenever you buy or sell, you will have to incur losses, right? So in the stock exchange, usually you deal with standardized products because it's easier to trade, and it's computerized, and usually is credit risk free. Because why? Because got the middleman, the stock exchange, to settle your money, right? Over the counter usually is a little bit different from the stock exchange. It's usually for non-standard customized product where you can customize, and there are usually some credit risk involved also lah, right? Because sometimes you deal with the dealer over the phone, you might not have know the person very well, and the person might just simply after a few months later or a few years later might just run away, right? So you never know. Stock exchange is an organization that basically provide a marketplace for you to do trading, right? The biggest worldwide largest stock exchange is actually the New York Stock Exchange, right? it's by far the biggest market capitalizations where a lot of companies like to get their stock listed in New York. Why? Because it's the financial hub, right? For everything, everybody like to be there, and there's a lot of funds going on. There's a lot of trader, and it's easier for people to raise money to sell and buy and sell. Right? Can you imagine you want to list your company stock in some unknown small stock exchange? Then you see that the price won't fluctuate. Nobody is buying your shares. It's going to be very boring. So that's why a lot of people like to go America. They like to be listed in those big financial hub, okay, such as Hong Kong, Shanghai, Japan. So those renowned, right, to get their company listed. So where a lot of big financial companies, right, they will basically be there to do trading, right, to buy. That's where the big players are, right? So that's the stock exchange. So this is SGX. If you haven't been to the SGX website, you can just do www.sgx.com, right? So there you have the stock exchange for Singapore, right? So this is the STI Index. You might come across this index. So index is basically about, I think it's a column, they bundle like about 30 blue chips, Singapore blue chips, right? Like DBS, OCBC, usually local bank, SIA. So they basically have these 30 stocks come together, and then they find some averaging price, and then they get listed as an index. Why people look at these indexes? Why is it so important? Because it's a reflection of your local stock market, right? Dow Jones Index. People will look at the Dow Jones Index to have a sense of directions, whether the market economy is doing well or not doing well. The companies are giving dividends or not, right? It basically is like a barometer or like thermometer to to tell people about the mood of the stock exchange in Singapore, right? So like in Singapore, basically it will be reflective in the STI index. And how do they get this index? It basically based on the averaging price of the 30 stocks that they will be looking at daily, right? So you can see that you can stock exchange has actually been around, right? Like in Singapore, wow, since inception, since 1987. Most of you might not be even born yet, right? So, but anyway, it's a long time, more than 50 over years. Oh no, maybe 40 over years, right? So there's a lot of data, there's a lot of trend, right? You can see this is actually you can actually plot this STI index over 1 year, 5 years, etc. You can see the all-time high is actually about 35,000, right? Sorry, not 3,500. Sorry, right? So it's about that peak. But look at it. What happened over here? Wow, that is recently, because of the 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 virus thing. Okay, it has caused the economy, the whole financial industry to plunge. Right, so you can see, that's why stock market can be dangerous, right? So you can see from over this drop almost 1,000 points and then drop down all the way, right? You'll be losing a lot of money, right? So that can be it's a risk that you have to take, right? So sometimes without warning, it will just drop very fast. So stock exchange, you have got the SGX, right? Then you have the stock broker. So you have the buyer broker, you have the seller broker. They will come. The brokers are basically middlemen to matchmake the buyer and seller, and then they will find a good price. Then they can co-broke. They can they can help you to sell your stuff, sell your goods, etc. So most people will make use of your broker, right? Like just now you saw, I actually even though I do it online. Okay, last time we used to have my stock exchange stock broker. I just have to make a phone call, tell him that what price I want to sell at what value, right, and how much, right. So I have to call my stock broker. But nowadays you can actually do it yourself through online, right. But then you still go through some kind of a stock broker, online broker, right. So they, even though they charge lesser, right, but there's still a commissions, right, that they will be charged. So you basically go through a broker to buy and sell your stocks, right? And then there's also the clearing house to basically clear your stocks, right? To ensure that you got your, once you purchase the stock, then the certificate of entitlement of your stocks will be actually put under your name, okay, electronically. Um, Over the counter is different from the stock exchange that we've been talking about. It's basically offline, right, off the exchange, right? These are some of the derivatives are basically traded directly between two parties. These are bilateral contract, and you will see that forward and swap. Some of the derivatives can only be found over the counter. They cannot be found on the stock exchange. So over the counter, the companies are usually smaller. Make it so why there are some stocks that is trade over the counter, because these company are too small to be listed on the stock exchange, right? Like Singapore Stock Exchange, right? When you want to list, doesn't mean that any company want to list on the stock exchange. You can just list your company on the stock exchange. No, the Singapore Stock Exchange has a very stringent requirement on what company can be listed, right? Traded on the stocks, right? Of course, if you are imagine if you are the stock exchange, would you just get any new startup to be listed there? You have a reputation to be built in a global financial hub. You know, you can't be having small little flies and companies who are not doing well, and you get them listed, and then what will happen? A lot of people will be investing in this company, and then end up they are not earning money. The stock price will plunge. They'll be losing money. So people will not come to trade at your exchange anymore. So usually for stock exchange to be listed, they, like for example Singapore Stock Exchange, they usually would require that the company could at least have been earning having profitable at least, right, for a couple of years, right? So before you can be listed. So they will want to have good companies, big companies, reputable company, right, to be listed there in their stock exchange, so that at least they are, they don't want to be seen as a stock exchange or marketplace that is selling lousy company shares, pennies, too much of this penny stock company, right? So it will become very insignificant to them. So here is just a table that illustrates the differences between the stock exchange and the over the counter, right? So some derivatives you can find, like future and option, can only be found in the stock exchange. Forward, option and swap only over the counter. So derivatives are, these are derivatives. Just now you saw there's a competitive. It's very competitive. It's an open outcry. People call, and now basically online, electronic. It's usually standards. This is usually non-standard. These are usually private, very private based. Excuse me. So here you can see the price are usually quite transparent and easily available. Just now you saw the dashboard. You can see a lot of price movement every second. Is very transparent. Everybody can see the price. Over here, over the counter, some of these prices, tradable prices, is less transparent, right? So unless you ask for it, right? Otherwise it won't be published so liberally, right, on any online website, right? So in a stock exchange, you generally do not know. Well, actually, when I buy and sell SIA share or buy DBS share, I don't know who am I selling to, uh, or who am I buying to. But it's not really important. The stock exchange will take care of it, right? They will be able to find a group of people or buyer, exchange it properly, right? Whereas in the over the counter, it's actually more personalized, a private base. The players, the buyer, the seller will basically see each other. They will know who each other they are trading with, right? So that's something. And here we also have another one, which is actually position are less likely to close, not that easy, because it's not standard, right? If you have a standard items, standard product, easy to sell, like iPhone, is something iPhone or stand uh, very pervasive. A lot of people know iPhone. They buy iPhone before they use. Right? Can you imagine if you sell a phone that is very unique, very not many people have it. Like maybe let's say Microsoft handphone. Okay, so it's not that, it's quite rather unique. Okay, it's not that common. So you find that it's much difficult to find a buyer or seller. Okay, so same thing, right? So if you are something that's not standard, you find that it's less tradable, right? And there are some expiries for your considerations. So why people bypass stock exchange, right? So for just now the earlier reason, that sometimes you cannot find the product, you cannot find the contract, you cannot find the things that you want to buy, right? So uh, so you have to go through this bypass the exchange, or you want to sell something, you want to do some contract, it's not the standard one, so you need to customize it for your own needs, for your own requirement. Then you have to go through some of this over the counter, right? Instead of getting it from the stock exchange, right? So sometimes you also want to avoid some exchange fees, etc. So these are some of the reasons why you people bypass, not because it's not available in the stock exchange. So open interest is basically the number of contracts that is actually available or shares available for you to do trading. Trading volumes are basically the amount of share that exchange daily or monthly or annually. Right, so people also like to look at the market capitalization to know about how big is your company. They like to compare. Is IBM bigger or Microsoft bigger? Right. Other than looking at the size of the company, the employee size, etc. Another thing is they look at the more reflective is their how much value, the financial value of the company. So they look at the stock price. For example, IBM share, right? IBM share, one share is like $115. So you have to compute based on the amount of shares that is actually out in the market that is tradable, right? So you have to times, right? So 115 times 1.5 million IBM share, so that will be the market value, right? So you don't just look at the market price. Maybe Microsoft is only, let's say, $10, right? So doesn't mean uh, the stock market company shares is lower, means it's a smaller market capitalization. You have to look at the number of shares that's out there. So maybe Microsoft is in trillions number of shares. So if you times, it's even bigger, right? The total, you got to look at the total market value, which is the price per share times the number of shares, right? So don't just look at the share price alone. Share price alone doesn't tell you the whole market. It's just that the market price is higher. Okay, so you still need to look at the number of shares that's out in the markets. Stock and bond. Okay, stock and bond. We'll be talking about this stock and bond market also. So there's a few ways companies can raise funds. When you have your own company, very much so that you want to have funds, right? You need to have capital. So how do you get your capital? You either borrow money from your parents, right? If you can't borrow money from your parents, from your siblings, your cousin, or your uncles, then you go to the bank, right? You get the bank to get you to loan you, right? So that's another way. Another way is, of course, you can raise your own fund by selling your company shares, selling your company ownership, right? That is through stocks, right? That's why companies, private listed company like SIA, DBS, all these, they get their money, funded money by selling their ownership, right? Some shares. So there are miniature common people like the private would like to have a ownership, right, in the company by buying some of the common stocks. So that's one way to raise fund. Another way to raise fund is by issuing bond. We also be talking about this. It's something like IOU, right? I give you an IOU. You lend me how much, then I'll pay you a fixed interest rate back, right, every year. So this is also tradable by the dealers. Okay, so you'll see that some of these financial instruments is basically used to reduce some of the risk. The financial market is quite volatile, right? Uh, inevitably you're going to face some financial risk, financial downturn. Uh, this could be due to some natural disasters. Earthquake can cause the stock market to plunge. A lot of things. It's very sensitive, right? The economy is very sensitive to all these natural disasters. Like now, we have got this virus outbreak, and that also can cause a lot of impact to the economy, right? So it's just like a few months ago, right? When I was last year, right? September, I was still in Bangkok, bring a lot of students to Bangkok for some innovations, right? And we really enjoy traveling, right? December, we also went to Italy. I bring my family to Italy. That was just like last year, end of last year, right? Nobody have ever thought that there's this natural disasters or virus outbreak that cause a sudden standstill, right? Can you ever imagine a few months ago? Can you even imagine you still thought that the airline industries is very good, right? Or be a pilot is all very good. They get good pay, good allowance. The stewardess are all very well paid. But look at what happened now. You can never thought that at this point in time, such an advanced stage in our economy and also advance in our technology, suddenly every country come to a standstill. Every country try to lock down, restrict people, and the plane all cannot fly. And it's only just for 1 month, and you can see such a big impact on the whole economic factor, the whole supply chain, right? So that some of these risks just come so sudden, right? And that actually have a deep impact on the financial market. So, financial markets are very vulnerable, right? Of course, when there's risk, there's also big gain, right? But you can be assured that now, even though the economies is down, right? You can see when the moment they start opening up the virus, somebody find a vaccine for the virus, the economy is going to ramp up already, right? Now it's just that we are all don't have the spread is so contagious, right? Everybody, so they lock down the whole place, the whole economy cannot move. But once people find a cure for the virus, right? People will start going back to their workplace. Economics will start to be alive again. People will start to travel. Okay, no more blockage, and then people will start to go. So when the market uh, goes up, okay, it will be assured that it will be ramping up very fast. So people are all waiting for the time. Okay, so that is the role of the financial market is also to provide a kind of a share of insurance, a way to share the risk. And that is what we're talking about later on. You will see that derivatives is something like insurance, where it's basically come in as an instrument to share some of the market risk in the time where market is not good and also in time when market is going up. Right? So people will come in to hedge the market. Right, I think this is going to be our last slide. So you can see that the world uh, is uh, is now very sophisticated and complicated, right? We always want to find a way to reduce our risk and mitigate our risk, right? Diversify our risk also, right? So you can see even like Walt Disney, right? And they built all the Walt Disney infrastructure in Japan, right? You know, Japan is a highly uh, uh, dangerous place to build because it's very vulnerable to earthquakes. Every year they have many earthquakes, and if I were to build something like Walt Disney big theme park in Japan, right? There could be one day the earthquake comes in and then collapse all my infrastructure, all my roller coaster. That's a big investment. So I need to have a way to to insure all my investment, and that is through excuse me, diversifying some of these risks. Oops, did I just cough so much? I hope I'm I'm okay, right? I hope I don't get one of those virus. So Right, maybe I'll stop here. So, hope you enjoy my first lecture. Um, Hopefully, everyone is well, and seriously hope to see you guys in person again. Not sure when, but now we are still in the lockdown period. So, uh, all the best to everyone. So, until then, I will see you in my next chapter. Right? Thank you very much for your attention. Signing out.